The narrative of markets changes all the time. So wouldn't it be interesting to find something that does not change all the time? I'm going to show you today what market makers who have to hedge their positions have to do in certain circumstances when volatility is moving up or down. So if you're interested, stay tuned. Welcome, fellow investor, market maker, trader, and speculator. In this video, I'm going to tackle the issue of market mechanics again. Like I said in the intro, markets, narratives changes all the time. Some days people are bullish, some months people are bullish, then this sector is hot and then the other sector is hot. And I think it's very difficult to keep track of what's going on in the market, especially, in modern times when viewpoints change overnight very fast, when we have a president who is very active on Truth Social, when we have all these flamboyant characters in the market, and the market seems to be more and more news driven. So what can you rely on as somebody who is following the markets? Well, you should look at the people, and I know what I'm talking about because I used to be one of them. You look at the market makers and the dealers, because we are caught or restricted by very strict risk management rules. So when markets move in a certain direction, and I'm talking about all the bells and whistles in which I will get to in a minute, we have to do certain transactions. If we don't do these transactions, we will lose money. So as we don't want to lose money, nobody wants to lose money, we have to do certain things, and these certain things are driven by, and in this video we're talking about implied volatility of the market, and this is having a massive influence, especially, over the last 15 years. It's getting more and more important to see what the option market is doing. Has an important impact on what's going to happen. And let's get into the presentation, and I fill it with life so that you will understand when I talk about a Vanna Rally and a Vanna Crash, what that really means. So, good. Welcome to the presentation part. Vanna Rally and Vanna Crash, market mechanics, how volatility moves markets. So, what is this topic all about? I wrote an article at Macro Hive, run by my friend Bilal Hafiz, one of the big market newsletters out there, which I occasionally write for. And my wife, an accomplished bond trader, is in their professional chat group, and it was March 2020. And we had these huge swings to the downside and to the upside. 1,000 points a day. No way. And for whatever reason, she was in the chat group of the equity boys. And the equity boys were throwing all sorts of funny names in there. Funny names I knew because I used them myself amongst us. But she hadn't heard them. And she said, they're talking about a Vanna Rally and a Vanna Crash. They're just making stuff up, aren't they? I said, no, they're not making stuff up. But thank you very much. You've given me a good idea how to get an interesting article into the next issue of Macro Hive. So that's what I did. And who am I? Quick introduction. This is my picture on Macro Hive. I think it's quite nice. Yeah. I spent 20 years trading equity derivatives. Obviously, that's 5 years ago, and it's now 30 years. I retired my career as a partner at Bear Stearns for the derivatives business. Structured products mainly, and currently he teaches as well as cooking, driving and cleaning lots. So that's what I'm doing in my spare time. And hobbies, which obviously in these modern times comes in quite nicely, is history, science fiction and politics, because it seems to me to be all the same. My professional background quickly, I studied law and economics in West Berlin at the time. Then I became a market maker at West LB, which at the time was the 5th largest bank in Germany. Made my career, became chief trader, head of trading for warrants and structured products. Then I moved to London, became head of equity derivatives for Penmure Gordon, one of the fine private banks over there. And then I joined Bear Stearns and eventually made it to partner at head of securitized equity derivatives for the United Kingdom, Germany, Austria, and Switzerland. I'm retired now. I occasionally give classes, and I've set up this YouTube channel to get a little bit of financial literacy into the market, because there's a lot of nonsense being taught or spoken about, especially if we talk about concepts like Vana, Gamma, all the more exotic sounding names in derivatives trading. So I've called them the Greeks, a Roman, and the diverse. What do I mean with that? The Greeks are obviously the delta, the theta, the rho. The Vega is from Latin, that's why it's Roman, and the diverse you can already see on the right side when we're talking about second and third order Greeks, charm, theta, decay, soma, color, speed, ultima. But today our focus is on Vanna. Vanna is the change. Look at the red box, it's easier to explain. Delta versus volatility. And let's get right into it. So how do we see crashes that are induced by volatility, or rallies that are induced by volatility? What's moving markets? Let's get into the structure of the market and start with the skew. What are we having here? This is the implied volatility you see over all options traded out there. And it's not a secret, you pay more, this is indicated by the rising line, for put options than you do for call options. Yeah? So we have the marketplaces of vanities where all the institutionals, the privates, everybody's in there. What do? They mostly have options, they mostly have equities, and they use options to mitigate their risk or to speculate with it. And this is mostly happening here between -1 and +1 standard deviation. You must think there's a bell curve on top of it, and 68% of all market movements usually are happening within these barriers. So, and they're called the delta 15 put, yeah, and the delta 15 call we have here. So there's a 15% probability roughly that we will exceed to the upside, and a 15% probability to the downside, in theory, on the model. So what does that say us? The market structure is, if you are here, you want to hedge yourself against the downside. Let's assume it is like a dating place. So you want to hedge yourself against that you don't meet the middle-aged, hamster-like looking, that's what I've heard before, market maker. You're more interested in meeting my colleague Murad, our Latin lover. Good-looking, smart, very charming. So you will spend more money to protect yourself from the downside, and you're actually quite fine with the upside we're having here. Yeah? Let's assume we have this marketplace here, and you're moving up slowly. That is all right for you, because you're an investor. You are invested in equities, and that's what you want to do. If they go up, fantastic. And you actually do not expect that you meet the really 2-3 standard deviation move to the upside. So you can afford and say, you know what, I'm long equities anyway. Let's sell some call options here at the top side. Yeah, that's why the volatility skew is lower, because there's more supply. Here on the downside, there's more demand. Who is offering you these puts and calls? Well, the puts are being offered by a market maker, right? So they sell them to you, which means the more you buy, the more they take up the prices. And the calls, which these investors here are using to generate an additional income by overriding. Yeah? They own the stock and they sell 10% out of the money call, 5% out of the money call. Get additional premium. If the market moves up, they have 5% in profit, and then eventually they get called, but they have an additional premium. So there's more supply. Who are they selling that to? To the market makers. If there's more supply coming in, what I'm going to do? I reduce the prices, and that's reflected by the volatility skew we have here. So general view of the marketplace, you see in front of you as an investor. So I have the opposite market in front of me as a market maker. The red line is the long calls you sold to me. So I'm, as a market maker, am I now long the call? Which means if market goes up, that would be good for me if I'm a speculator. And if market goes down because I sold the put, would be very, very bad for me, because you bought these puts as protection from me as the marketplace. I have a very good video out on gammas. I'll put the link in the description, and you can in detail see what that means, because the gamma has obviously a huge influence on moves, but today we are talking about implied volatility. And then let's go to the Vanna. Yeah? What's moving markets? And I'm showing you this very easy to understand graphic. Obviously, you're now raising your eyebrow and say, what do you want to do with that? So I thought, okay, I'll explain it later again. Let's go through some easy slides to give you an idea what is going on in markets and what we can derive out of that. So it's called the delta hedging, things that need to be done by market makers. In red, you see the market maker position. That's the out of the money puts. I'm short the puts, which means I'm delta long, which means if markets fall, I lose money. If markets go up, I make money. So it has a delta of plus 15. I've taken as an example the first standard deviation. And there are the out of the money calls. The marketplace has sold them to me, so I'm long the call, which means I am 15 deltas long. All these deltas can be added up, and at the moment I own no shares. So what's my position? My delta position is plus 30. If market moves up $1, I make $30. If markets go down, I lose $30. As a market maker, I'm actually quite agnostic. I'm not in the business of speculating whether markets go up or down. I'm in the business of risk management. So what am I going to do? I want to neutralize my delta. Out of this position, I just got from the marketplace, I'm 30 deltas long. So I'm going to sell 30 shares against it. And now I'm delta neutral, right? Which means if the market goes up or down by $1, it doesn't affect me at this point in time very much. I just keep that steady so that I don't have a huge exposure. Now it's the interesting bit. Volatility is contracting. What influence does that have on the position I have on my book? The out of the money put, the 15 delta, is no longer a 15 delta. Why? Because market is assumed to move less. If it moves less, the corridor it could go to is becoming smaller and smaller and smaller. And the delta is a measurement for the probability that we actually end up in the money. So if volatility is going down, the probability that this out of the money put will be in the money one day and have some worth has decreased. So it goes down to only 3 deltas. The same is true for the call. Yeah? The volatility corridor has shrunk. The probability, which was 15 delta at the beginning, has now shrunk to 2 deltas. So, and I'm still short the 30 shares, which I sold here to get my portfolio hedge neutral. So my new delta, if I add these all together, is minus 25. So wait a second. Volatility is going down. What does that usually mean? Markets are more confident to the upside. Yeah? Maybe they're already slightly rising, and I'm delta short now out of this position because the option delta has decreased, but my short shares I have to hedge this position haven't done anything. They are still at minus 30 deltas. So what do I have to do now? I have to buy 25 shares to get my delta to plus minus 0 again. So you can already see if volatility comes down, market makers who have these positions in their books realize, I need delta. How do I get delta? I buy shares. Volatility falls, market makers goes in, starts buying. So we have a calmer market, maybe in a light uptrend. Volatility is falling, and now the market maker gets in and also buys shares. What will happen? Markets go up. Now let's look at the other side of the equation. Same example we had before. I'm short the out of the money put. I'm long the out of the money call. I have my hedge position on, 30 shares short against it. My delta position is plus minus 0. So now volatility is expanding. The out of the money put, with the market expecting a huge increase in possibilities, will increase because the delta is measuring the probability that this guy will be in the money at expiration. Same is true for the out of the money call. Could also increase in probabilities when volatility is expanding. So, and I'm still short the 30 shares. So what's my position now? I have a delta new of plus 30. 30, 30, minus 30. I was delta neutral here, had a 0 delta, and now I have plus 30. So I'm long. If market goes up, I make $30. If market goes down, I lose $30. So, but we have already the scenario of volatility is expanding. When does that usually happen? Because at the moment we're in a bizarre situation where markets are vol up, but that's for another video. So what usually happens or has happened is volatility has gone up because market has taken a dive. So what do I have to do to hedge my position? I want to get out of my long position here. As a market maker, my job is to keep my book neutral, manage my risks, and do a lot of bid and sell on this side, make my money by providing liquidity while keeping the risks small. So I start selling shares. I'm sorting another 30 shares. And what does that do to the market? Volatility is already up. Market is in a dive. Now I'm putting fuel on the fire. So the market will probably get more pressure from the market makers, from the dealers as well when volatility goes up, because we simply have to hedge our positions to keep our delta neutral. Now my delta is plus minus 1 again, plus minus 0 again. And this is the simple function if you look at it in terms of probability. What's happening? What's the guess of the market? Will we see a wide variety of prices, a huge range or a smaller one? If volatility decreases, it's less likely that we reach the strike price of our calls and our puts, so the delta is getting smaller. And if volatility is expanding, the delta becomes more likely, increases, and therefore becomes more likely to be in the money, and I do my hedge transactions accordingly. And now you might even be able to understand this tiny little slide. We are here at the 100. I have a delta out of the option position of plus 30. In red, we have the Vana, how my put option reacts to an increase or decrease in implied volatility. And in green, we have a line, how my delta will react to an increase or decrease in volatility at each price point we have. Again, they're additive. I can add them together and I end up with a position Vana, which we see here. So I'm short the put, I'm long the call, and that's my Vana, which is highest at the money right now, where I am at 100 for these 15 deltas. That's why people trade 15 deltas or prefer to do it, because there's the highest sensitivity to a change in implied volatility in there. So you can already see we have a positive delta here. That's this line for this position. Out of the option market, it's at plus 30. So if volatility is falling, plus 30 deltas minus a positive Vana, delta gets smaller. What do I have to do? If volatility falls, I have to start buying equities, building that up, and vice versa. So if you are interested in this slide, press pause, try to get it together, but the two slides in front of it are, I think, the best way to explain the concept of Vana, what it does to positions, and which hedge transactions that requires from market makers and dealers. Because customers usually, they buy something or sell something and then they look at it. And they're happy because they had an idea beforehand or strategy, and they don't do anything. Market makers are the opposite. We have to hedge all the time, and that's what you can see in the market. You see the footprint, and all of this can even be calculated, and there are good service providers for the Gamma, for the Vana, for the Charm. Time for another video. Spot Gamma comes to mind, Mentor Q comes to mind, unusual whales come to mind. For small money, professional investors are using it as well, because if you understand the concept, you actually know what might happen in markets when the guys who are not interested in playing directional moves, market makers, hedge their transactions, and what this will do to supply and demand in the marketplace. If you don't believe me, the blue line is the VIX, and the red line is, or the bar chart is the S&P, and you can see what happens when volatility is increasing. Market starts dropping. Why is that? We just had the explanation. If the market maker book looks, most of the time, like I just explained to you, market makers are required on the way to the downside with increasing volatility to sell shares. What's happening when volatility is contracting again? Market makers, with the position we've just assumed, have to start buying stuff, fueling the flames. So where are we now? That's the interesting point. Volatility is at levels where it usually mean reverts? You can't say that. That's actually where we are at the moment. The average in the VIX is 19. The mean is at 17, which means 50% are below, 50% are beneath it. But there is some sort of a hard floor at 10. Yeah, volatility barely goes below 10, and the VIX is a bit of a cheat instrument anyway, because you can't trade it. You can't trade the VIX future, so it's overstating the situation. But what we can see here at the moment, volatility is already very, very low. What's happening next? If volatility goes up and clients have bought puts here and sold calls there again, go back a couple of slides and you'll see exactly what market makers will be required to do. Yeah? If volatility is increasing, markets are falling, then we accelerate the move to the downside. Good books already in my other videos. If you are interested in the option, the one book you actually should have on your desk is Option Volatility and Pricing by Sheldon Natenberg. If you want to have fun doing a good read while you're on holidays, Random Walk Down Wall Street or The Misbehavior of Markets. And obviously, if you're interested in the formulas, go into Option Pricing Formulas by Espen Gardner Haug. And I hope you will enjoy these books when you find the time. Otherwise, stay on this channel. And I want to thank you for your attention. If you like the lecture, please like, share, comment. Motivates me, motivates my team to bring out more of this content. And if you want to read the article I told you about at the beginning, go on our website, thetechnicalbrief.com, in publications and research, and you'll find a lot of nice articles. I say so because I wrote most of them, about volatility, gamma, Vegas, everything that's moving markets coming from the option market maker side. The view a lot of people talk about, but not many do really understand because they haven't done it and will not be able to give you the insight I hope I was able to put in front of you. Risk disclaimer, everything I did today is a lecture. It's not investment advice. I'm not in the business of advising people on their investments. I'm in the business of being retired. I'm in the business of spreading financial education. I hope you enjoyed that. And I hope I see you soon on this channel. If you like this video, I'm linking my video on the gammas, which I published a couple of weeks before, here in the links. Have a look at that, and yeah, stay tuned. If I find the time, the next video will be on charm to explain market mechanics. Have a lovely day. Bye bye.